We shall commence this module by discussing the important functions of money. Money has two important functions. Primarily, it acts as a medium of exchange, and secondarily, it is a store of value. The demand of money also comes from these functions, and hence individuals and businesses wish to hold money in cash and in the form of assets that can be substituted for money. Classical economists considered money as a means of payment or medium of exchange, that is, making payments for their purchase of goods and services and vice versa. In other words, they want to keep money for transaction purposes only. Keynes, in his theory, on the other hand, used a new term, liquidity, for the demand of money. According to him, there are three motives which lead to the demand for money in an economy. First, the transaction demand. Second, the precautionary demand. And third, the speculative demand. In short, he laid stress on the store of value function of money. After studying this module, you shall be able to know the functions or uses of money, know the classical approach to demand for money, analyze the Keynesian and the modern view for demand of money, evaluate the difference between the classical approach and the Keynesian approach for demand of money. Assess the relation between the various factors like income, rate of interest, etc. and their impacts on the demand and supply of money. Let us now discuss and compare both the theories in detail. Firstly, we will discuss the classical approach or the quantity theory of money. The classical theory laid emphasis on money as a medium of exchange, that is, money as a medium of buying goods and services. So, every transaction which involves purchase of goods and services or raw materials, assets, require payment of money and hence will be included in this approach. But this approach considers certain assumptions. First, money according to the classical model is neutral. For example, real variables such as the real interest rate are not affected by nominal money supply. Second, neither output nor employment are affected by money and nor does money has any role in determining them. The classical economists inherited their views from the quantity theory of money. They calculate the demand for money in terms of the average price level times the volume of transaction in the economy because money acts as a medium of exchange and facilitates the exchange of goods and services. The equation gave is as follows. MV is equals to PT, where M is the total quantity of money, V is the transaction velocity of the circulation of money, P is the average price level, and T is the volume of transaction undertaken in an economy. Here, the term PT is the demand for money which in turn depends upon the volume of transactions to be undertaken in the economy, and MV represents the supply of money which is given and in equilibrium equals the demand for money. Thus, its underlying assumption is that people hold money to buy goods. Third is that V is constant because it depends on the pattern of the receipts and payments. Fourth, T is constant because GDP is determined in the real sector with factors such as the size of labor force and capital stock. Fifth, money supply is a stock, that is M. Now, the Fisher's identity therefore is MV is equals to money supply, PT is equals to money demand, and hence money supply is always equals to the money demand. Next, we will discuss the Keynesian approach or the general theory. J. M. Keynes in his theory laid stress on the second function of money, that is the store of value. He emphasized the role of the other factors such as rate of interest, expectations regarding future interest rates, prices, and incorporated them explicitly in his analysis of demand for money. Keynes used the term liquidity preference. It defines the requirement of a person to hold cash balances, but the question is how much a person should hold in the form of ready cash and how much can he lend. According to him, money is an asset and people want to hold it for three reasons. First, for the transaction demand. Second, for the precautionary demand. And third, for the speculative demand. The transaction demand for money. The transaction motive is related to the demand for money to settle the current transactions of individuals and business firms. People hold cash to bridge the gap between expenditure and the receipts of income. As it is known, the receipts and the incomes do not coincide, there lies a gap. Incomes are received weekly or monthly while the expenditure goes on daily basis. A certain amount of ready money therefore is kept in hand to make the current payments. This generally depends upon the individual's income, the level at which the income is received, and the method of payments prevailing in the society. The business also needs to have a proportion of their resources in the form of money in order to meet daily needs of various kinds. They need money to pay for raw materials and transport, to pay wages and salaries, and to meet all other current expenses incurred by any business firm. The money which they need to keep ready for transaction purpose is defined by the level of turnover, that is, the volume of trade of the firm in question of the business. The greater the turnover, the larger in general will be the amount of money needed to be kept spare for the current expenses. The money demand for transaction motive arises primarily because of the use of money as a medium of exchange. The transaction motive of holding money is affected according to Keynesians by two important factors, namely, first, rate of interest, which is initially taken as inelastic by Keynesian, and second, by the level of income. Let us discuss these individually. First, rate of interest as the determinant of the transaction's demand was taken inelastic initially, but later it was understood at a higher rate of interest may lead to a more economical use of active balances. It is not perfectly inelastic. Second, level of income, since the transaction's demand for money arises because individuals have to incur expenditure on goods and services during the receipt of income and its use of payment for goods and services, money held for this motive depends upon the level of income of an individual. So, a poor person will have to hold less money for transactions motive as his expenditure is less as per his less income. Contrary to this, a richer person will have to hold more money for transaction purpose as his expenditure will be relatively greater. The transaction demand for money is directly proportional to the level of income and is expressed as follows. L1 is equals to KY, where L1 is the demand for money for transactions purposes, K is the proportion of income for transactions purposes, and Y is the income of the individual, or L is equals to a function of Y and R if we include interest sensitivity of precautionary demand. The next is the precautionary demand for money. The precautionary motive refers to providing for contingencies such as sudden expenditures and unforeseen opportunities of advantageous purchases. Both individuals and businesses keep some amount of cash in reserve to meet such unexpected needs. Individuals hold some cash to provide for illness, accidents, unemployment, and other such unforeseen contingencies. Similarly, businessmen have to keep some cash in reserve to face the unfavorable conditions or to gain from unexpected deals. Money under the precautionary motive is the money kept in reserve like water kept in reserve in a water tank. Again, the precautionary demand for money is directly proportional to the level of income and business activity, opportunities for unexpected profitable deals, the cost of holding liquid assets in bank reserves, etc. It is also inversely related to the high interest rates. This is expressed by the function L2 is equals to a function of Y and R. Now, we combine L1 and L2. Moreover, the interest elasticity of transaction or precautionary demand is ignored. Thus, M1 is equals to L1 plus L2 plus M1 bracket Y bracket close. Now, the third demand for money is known as the speculative demand for money. The speculative motive is to hold one's resources in liquid form in order to take advantage of market movements regarding the future changes in the rate of interest, for example, by investing in bonds. The basic idea of holding money for speculative motive was a new one propounded by Keynesians. Here also money serves its secondary function, that is the store of value. The cash under speculative motive is used to make speculative gains by trading in bonds whose prices fluctuate. The speculative motive of holding money is affected according to Keynesian by primarily the level of income. Let's discuss this in detail. Under speculative motive, there is an inverse relation between the interest rate and the amount of money held. That is, if bond prices are expected to rise, individuals will buy bonds to sell. If, however, bond prices are expected to fall, individuals will sell bonds to avoid capital losses. The reason for this inverse correlation is that at a lower rate of interest, less is lost by not lending money or investing it, or by holding on to money. While at a higher current rate of interest, holders of cash balance would lose more by not lending or investing. This is shown in the figure. Along x-axis we represent the speculative demand for money, and along the y-axis we represent the current rate of interest. The liquidity preference curve LP is a downward sloping towards the right, signifying that higher the rate of interest, the lower is the demand for money for the speculative motive and vice versa. This can also be worked out with the help of the equation. V is equals to capital R divided by small r, where V is the value of bond, capital R is the return on bond, and small r is the market rate of interest. So, a bond which is rupees 100 V and carrying a 6% rate of interest, that is small r, gets an annual return, that is capital R, of rupees 6. That is, V is equals to rupees 6 divided by 0.06, which is equals to rupees 100. When the market rate of interest rises to 8%, then V is equals to rupees 6 divided by 0.08, which is equals to 75. When it falls to 2%, then V is equals to rupees 6 divided by 0.02, which is equals to 300. The total demand for money. Money held for transactions and precautionary motives is primarily a function of the level of income, that is L1 is equals to a function of F, and the speculative demand for money is a function of rate of interest, that is LS is equals to a function of small r, which is also known as the rate of interest. Thus, the total demand for money is a function of both income and interest rate, that is L is equals to a function of Y and R, where L represents the total demand for money. MD is equals to LT is equals to a function of Y and R, where Y is the level of income, R is the rate of interest, F is the function, L is the quantity of liquid assets, and LT is the total amount of liquid assets, or MD is equals to money demand. We will be comparing the Keynesian approach with the classical approach on the basis of some objectives. They are as follows. First, motive of the theory. The motive of the classical theory is only to consider money for the transaction purpose, whereas the motive of the Keynesian theory is to hold money for only the transaction purpose, but also for its other functions like precautionary and speculative purpose. Second, utility of money. The utility of money under this approach is to hold money as a medium of exchange, whereas the utility of money under the Keynesian aspect is to hold money for not only as a medium of exchange, but also for its secondary objective, that is store of value. Third, nature of money. The nature of money under classicals is to be neutral, whereas the nature of money under the Keynesian approach is considered to be unstable as it is affected by other factors like the level of income, rate of interest, etc. Fourth, substitutes of money. Now, under the classical approach, there are no substitutes of money. However, under the Keynesian approach, goods, that is money stocks, are considered to be the substitutes of money. Relationship with output. Output not considered to be affected under this approach by the level of transactions in an economy, nor does the economy by the level of output under this approach of classical theory. However, according to the Keynesian approach, Output has an effective relationship with the economic activities. Now, relationship with employment. Under the classical approach, full employment was considered as a basic assumption under this approach. However, under the Keynesian approach, there is no such assumption taken by Keynesian to explain his approach. Next is velocity of transactions. Under the classical approach, V is considered as constant, whereas under the Keynesian approach, velocity is not kept constant because it depends on money stock. Relationship with the income. Under the classical approach, the money supply has no relation with the level of income of the individuals in an economy. That is, income is considered to be constant. Whereas, under the Keynesian approach, income is taken into consideration. The next objective is relationship with the rate of interest rate on real stock. Now, under the classical approach, since real stock is not taken into consideration, the respective rate of interest is also assumed to be constant. However, under the Keynesian approach, rate of interest is the major concern as it is one of the most important factors which determines the quantity of money to be held with the individuals. Let us now summarize what we have learnt in this module. Demand for money arises from its two major functions, medium of exchange and store of value. Different economists define their theories differently, of which the classical view of the classical theory considered only the transactional motive of money to describe its uses. They proved their theories by stating that the demand of money is determined by the supply of money. That is, demand creates its own supply and supply of money in the economy will create its own demand. For this, other factors like the level of income, rate of interest, velocity of money, etc. were considered constant. On the other hand, Keynesians in his general theory specified that the money is held by individuals not only for the transactional motive but also other motives like precautionary, speculative, etc. He, in other words, focused on money as a store of value. In his study, he laid down the relationship between the different factors like the level of income, the rate of interest, etc. with that of the quantity of money which people will hold ready with them. He even defined the direct and indirect relationship of money stock with that of the level of income in an economy and the rate of interest on different investments. Keynesians also proved that equilibrium at full employment is not always assured because prices or wages are sticky due to market imperfections. Both the theories have their critics and many more theories like that with portfolio approach, etc. were even coined later by freedmen overcoming their limitations.